Are you ready to make your portfolio immune to market mayhem? In our third Spotlight episode, we'll reveal proven strategies and fresh ideas to fortress your investments, even when the headlines get wild.
So government policy has enacted the repeal of free trade and globalism.
Broadly speaking, CLOs have been the domain of sophisticated investors.
Tune in to discover how smart diversification, resilient assets, and a forward-thinking mindset can help build the portfolio that's built to last through the ups, downs, and everything in between. Let's get you market-proof fast. Known for their savvy in areas like gold, natural resources, and emerging markets, US Global is led by CEO Frank Holmes and is the force behind creative ETFs like JETS, JETS, and GOAU, G-O-A-U, Go Gold. Whether it's precious metals or global innovation, they focus on key opportunities to help investors grow their wealth. I recently sat down with Alejandro Esquivel, investment analyst on the US Global team. So royalties as an asset class are an estimated US $2 trillion market. So Alejandro, for investors looking to have a well-diversified portfolio and limit risk, are mining royalty companies worth looking into?
Royalty models are actually a very interesting concept because you have that limited capex, so capital out the door up front, which is then paid back to that royalty company through the stream of cash flows or sales of gold from the mine. So think about it, if you're putting up capital for something and then continuously repaid as long as they're operating, and then you do that across 20, 30, 50, 100 mines across the globe, you really start to diversify your risk as far as jurisdictional, as far as operator, and as far as capex.
COVID showed that downturns can be a great time to find value in temporarily depreciated sectors. Does US Global see any trends in this area that are relevant today?
Government policies are a precursor to change, and that's one idiom that we believe here at US Global Investors. We see in 2020, during COVID lockdowns, that tourism and travel demand had continued but had been artificially suppressed by lockdowns, by government policies. When it was reopened, that demand that had once been there shot up because of how much it had been suppressed. Think about pressurization and how much, when pressure is released, all that demand came to market. We see a similar strategic advantage from the government policies that are being enacted today.
How about shipping and logistics?
Shipping and logistics has been taking a toll from tariff wars. So government policy has enacted the repeal of free trade and globalism. And what we see is that shipping and logistics is going to continue because of the demand for outsourced goods and outsourced providers of goods. And we see that demand currently suppressed from government policies. As soon as we get trade deals renegotiated across countries, we see as shipping and logistics as an opportunity.
Thanks for joining me today, Alejandro, and for the excellent insights into some of the opportunities US Global is currently behind. Meet David Jarvis, President and CEO of Corton Capital. David's a veteran of Canada's hedge fund industry and is known for a hands-on investing and innovative approach to alternative funds with more than 30 years experience across trading, compliance, and portfolio management. David leads Corton Capital in delivering disciplined, data-driven strategies that always seem to uncover value where others overlook it. So David, how does your latest ETF give individual investors access to traditionally exclusive asset classes?
This ETF provides investors with an opportunity to indirectly invest in private credit markets. CLOs have been around for a number of years. and they are asset-backed securities structured into packages with over 100 individual loans, all secured by the assets of the underlying company.
How does your ETF balance yield and capital preservation compared to traditional fixed income or savings products in today's volatile market?
Broadly speaking, there are two types of traditional fixed income products that are issued. The first one is your typical bond, which has a series of fixed payments and a balloon payment at the end. The other type are floating rate fixed income products. The principal amount is fixed at the end. However, the amount of interest that you receive goes up and down in response to changes in the interest rate environment. In a rising interest rate environment, your traditional fixed income bond is going to go down in value. That is not protecting you. That is not helping you. This is completely offset by the floating rate product, whereas interest rates go up, the amount of interest that you receive will go up, and yet the principal amount remains the same. In short, the Corton Enhanced Income Fund should not actually experience any significant changes in price given changes in interest rates. The only thing that will change is the amount of interest that you receive.
So how does that compare to traditional Canadian ETFs?
The yield on the Corton Enhanced Income Fund is typically going to be between 90 and 120 basis points higher. And that is very important without the exposure to changes in interest rates that could cause the value of a traditional fixed income bond to go down. That is not likely to happen with the Corton Enhanced Income Fund.
So what role do AAA-rated CLOs play in your ETF, and how do you manage risk and liquidity for retail investors?
Broadly speaking, CLOs have been the domain of sophisticated investors. It is a very deep and active market that is traded extensively in the United States and Europe. As I said earlier, the CLO market is extraordinarily liquid, and as such, whenever there's a demand for a redemption, there's absolutely no problems creating liquidity to sell CLOs within the portfolio to meet that particular redemption requirement.
Thanks for joining me today, David.
Subscribe to get notified when our next episode drops. And until then, happy investing.